And so here's a good example of lump sum purchase and how we apportion costs. So this can be this is relatively complex, but let's say we purchased land, building, and land improvements. So I bought a building that I want to run my office out of. And we paid $90,000 to acquire the building, the land itself, and fences and shrubs and everything that came on the land. This is probably 100 years ago for this price, but that's okay. Or we're in Ohio somewhere. So we paid $90,000. Well, we have to allocate the value of the land, the value of the bundle purchase to each of the assets, the building, the land, and the land improvements. Each of these assets are going to be disclosed separately on the financial statements. It's all going to be in plant, property, and equipment, but then there'll be a disclosure stating what's in that plant, property, and equipment. And so generally we'll receive appraisal report saying the building's worth $60,000, the land's worth $30,000, and the land improvements are worth $10,000. So the appraised value is $100,000. We got it on sale. We got it for $90,000. But we have to allocate the $90,000 we paid based on the fair value or the appraised value of the assets. And so I can see you getting appraised values. You'll have to determine the percent. So if this percent is 60,000 divided by 100,000 is your 60%, 30 by 100 is 30, 10 by 10 is 10%. And then you multiply it by your 90,000. So 90,000 times 60%, which we determine here, is your 54, 36, and 9,000. And then this will be your final journal entry, the apportioned cost, which is really just our allocated cost based on the relative fair market values.